as you know, there's so much drama surrounding Jerome Powell and the Fed. I need you to help us make sense of what's going on, because to me right now, it almost seems like the tale of two Feds. It reminds me of those books we read as kids that, had choose between the endings. Turn to page 29 if you want to meet the dragon, or page 30 if you want to go down the gold road. My question to you is, with the talk of inflation and now Jerome Powell saying, okay, perhaps it's not as transitory, is the market prepared?
Daniela, that's a great question. And I'm delighted that as a journalist, you use the word drama because there's a couple things to consider. One, the sort of drama around it, the story. The second, and more serious, I think, is the reality. And I'd like to begin, Daniela, with my normal disclaimer. I'm not an economist. I'm an investor, I'm a speculator, I'm a lender, but I'm not an economist. It would appear to me that people have been inured living through 40 years of very benign economic conditions not to expect inflation. We've seen a circumstance where inflation and where the interest rate has fallen for 40 years. We have come to believe in the Fed put. We have come to believe that Mr. Powell and his predecessors were more important to our financial well-being than our own efforts and our propensity to spend. And I think the consequence of that is that people have ignored the arithmetic of basic inflation. People have ignored the warning signs because they haven't experienced inflation for 40 years. Just as in the 80s, when inflation was on the decline, people's expectations were formed in the 70s. And so people were afraid of inflation for 10 years after one would suggest that the inflation dragon had been slayed. The circumstance that we have now, I think, is that people have come not to expect inflation. And so even though the warning signs are in place, hell, the warning signs, the arithmetic, even though the arithmetic and the evidence around inflation are in place, people have been conditioned by 40 years not to expect it, and it will certainly surprise them.
Well, I just want to share with you a quote from Jeremy Siegel of Wharton, who is generally positive when it comes to market forecasts. He's now warning of a painful quarter for Wall Street. He says, we're headed for some trouble ahead. Inflation in general is going to be a much bigger problem than the Fed believes.
Maybe a bigger problem that he suggests, given that he's worried about a quarter. I'm worried about 5 years and 10 years. I think we've become inured, among other things, to the drama, which is what causes us to think about quarters. If you think about the arithmetic around inflation, Daniela, think about it from the perspective of the saver. The US 10-year Treasury generates 125 basis points, which means the government pays you 1.25% a year to borrow your money for 10 years. The government's own statistics suggest that the purchasing power of the currency that they're paying you back in is declining by 5.5%. So over the course of 10 years, you experience 4%, well, 4.25% negative yield, which is to say at the end of 10 years, over 60% of your purchasing power is destroyed. I'm not worried about the quarter. For myself, I'm not worried about anything. For the length and breadth of American wage earners and savers, and for the strength of the US economy, I'm plenty worried because the arithmetic around inflation, particularly for savers.
So here's my question to you now. In the 1970 style inflation, we saw the rush to gold, how people were turning to precious metals. Why are we not seeing that yet today? Is it because people haven't bought the inflation story yet, or are people looking to Bitcoin today rather than gold?
I was going to ask you that, Daniela. You're a journalist. I'm just a loan shark. I have three possible explanations. I think that the biggest competition that gold faces is the S&P 500. People, including Warren Buffett, believe that the finest private businesses in the world have sufficient pricing power that they themselves are good inflation hedges. Buffett perhaps proved that in the decade of the 1970s. I would tell some of your listeners, don't try this at home. He's a pretty smart guy. But I think that the biggest competition that gold faces among retail investors is the S&P 500, or for the more speculative elements of your audience, the triple Q, the technology stocks. For family offices, when I pose this question to them, which I do frequently, most family offices have been taught over the last 40 years that the way you defeat inflation is to buy fairly high quality real estate with long-term fixed mortgages. The idea being that inflation raises the cost of new construction. Taxes and fees on real estate only go up, and you can raise rents a little bit, but your cost of capital stays firm. So if you have a 30-year fixed rate at 3 and change, which stays intact for 30 years, and your rents increase at 3 or 4% per annum, the delta between the return on capital and the cost of capital helps you keep pace with inflation. The only pushback that I can give you there is, and this game has been very good to me, by the way, the only pushback that I can give you is if interest rates rise, the cap rates that you pay for this real estate or you receive when you sell it fall. And relying solely on an increased delta in the face of the fact that cap rates probably can't fall anymore becomes dangerous. With regards to the cryptos, I think this really is drama. The market cap of precious metals relative to other asset classes worldwide is infinitesimal. And the market capitalization of crypto relative to other assets is even more infinitesimal. I think maybe they compete with each other on the speculative fringes, on the margins. In other words, a $10,000 gold buyer may disintermediate into crypto. But for things like sovereign wealth funds, university endowments, ultra high net worth families, there is no quarrel. They are both such small asset classes as to be irrelevant. Your audience and my audience, who are more speculative and care about such things, are determinedly concerned about the relative market share of gold and cryptos, but neither of them matter in the global scheme.
Well, interesting you say that. Can we explore that a little further? Because there is the school of thought, and I've spoken to people who firmly believe this, that Bitcoin has to chip away at a market cap. It has chosen gold almost as that low-hanging fruit of, hey, this is an easy one to pick on. It needs to take away some of that market cap from gold to be sustainable.
I don't think that the economy or investors care much about what the crypto community thinks they have to do. I don't have the appropriate numbers for crypto, but let's look at precious metals market share. In the United States, precious metals and precious metals related investments comprise about 0.5% of total savings and investment assets in the country. That's down from a 3-decade mean of 1.5 to 2%. And crypto's even smaller than that. We flatter ourselves in these business by thinking that we're an afterthought. My discussion with regards to gold is that gold doesn't have to win the war against crypto, which on a global scale is an irrelevancy. And it doesn't have to even win the war against the US dollar. It has to lose the war less badly. If ownership of precious metals and precious metals related assets in the US market returned to its 3-decade mean, demand would triple. There is lots of room for precious metals and lots of room for cryptos. I personally believe that they serve very different functions. They are competing right now for a market that's highly visible, that you and I both deal with and are part of, but the competition between them is irrelevant on even a national scale, but much less an international scale.